Well, joining us to get across the open now is Mark Gardner from MPC Markets. Mark, welcome to Monday. Thanks for joining us. Look, global markets ending the week high. We are expecting a bit of a mixed open locally, pretty flat, it has to be said. What did you see, particularly on Wall Street on Friday, as it rounded out a very positive week?
Yeah, look, it was the second best week of 2025 and it's really just followed on from that optimism from that investors have around the Chinese US trade deals, etc. Obviously, after the close, though, futures were open, but the actual day session of the US stocks was closed. But Moody's downgraded the credit rating to AA1, which means that the US, for the first time, does not have at least one of the ratings agencies with the AAA rating. We've seen futures drop around about 0.8% this morning, and bond yields start to rally, particularly in the 2s and the 10s. So I dare say we're going to have a bit of a rough start this morning, and the general implications of that downgrade, while they're trying to push the US tax bill through at the moment, is going to make for a few delays here and there.
Yeah. I mean, you mentioned that tax bill. Obviously, that's just going to see that debt position deteriorate even further.
Americans actually knocked back the bill because there wasn't enough fiscal discipline in it, and then obviously the Moody's downgrade as well is very much concerned around debt and overall global equity markets here with the 2011, 2023, we've had S&P Global Ratings and Fitch Ratings downgrade the US from that that AAA rating, and the usual consequence was about 10% over 3 months. So we still have that backdrop of a little bit of uncertainty. Consumer numbers were very much brushed off on Friday night, despite the fact that they're at their worst levels in quite some time. So I would expect this to we kind of thought this was, we definitely thought this was a bear market rally. I didn't quite expect this to be the catalyst, obviously, to drag it back down again, but we were certainly expecting sometime over the next 3 weeks for there to be a pullback back into the middle of the range at the very least. So this might just be a trigger for that over the coming weeks, because the economic numbers that are starting to trickle out are not so good for the US economy, and that was driving bond yields lower. But obviously this downgrade is going to counter that as well. So we'll have higher bond yields and worsening economic numbers.
Yeah, and of course we have seen that reprieve, if you like, on tariffs between the US and China. Nonetheless, the tariffs are still there, Mark. It has already started having an effect. And you take also a look at the latest read on consumer sentiment at a 3-year low. 1-year inflation expectations up to 7.3%. That's the highest in more than 40 years.
Yes, and probably deservedly so. As you know, as you just said, the tariffs are still there. They're still at 10, sometimes 20%. So, it just further emphasises the need to get a deal done quick. The Moody's downgrade for me is, was fairly logical. I've mentioned it on, various segments quite a few times over the last sort of 3 to 6 months. And it was always going to be a risk. So I dare say that, that investor optimism that we've had for the last, 3 weeks, which has seen one of the steepest bear market rallies in recent memory, probably start to give a little bit of that back, and you might start to see some big tone come into those gold miners again, which at the moment have pulled back so far. They're actually pretty decent buying levels. So we'll probably be focusing on trying to buy some of those back, and we have been returning to cash over the last 2 weeks anyway. So just in preparation for a pullback in the market generally.
Just focusing on what we're likely to see locally here then, Mark. I mean, you mentioned maybe some of those movers. Look, of course, the big news this week is going to be that Reserve Bank decision tomorrow.
Yeah, I think that's this downgrade, and then obviously inflation expectations going through the roof in the US just adds further uncertainty for central banks overall. I don't think they're going to be swift to move or encouraged to make any preemptive moves until they see the next month or two of data. Whether we get a rate cut this month or whether we get a rate cut next month or July, I don't think in the scheme of things means a hell of a lot. So we don't expect the RBA to cut rates this week. I know but it depends on who you ask. Anyone who's involved in mortgaging or the housing market or the banks that obviously benefit from it are very pro rate cut. But ask any sort of bond trader or economist that doesn't have that self-interest involved, and they'll probably tell you that this, that we don't need one right now. But yeah, basically we're going to have to see the next month or so of data, and I don't think the RBA needs to be rushing. And they'll probably take the same or similar view to the Fed, that they need to see how things are going to play out with this trade war.
So, I mean, you mentioned perhaps what's expected or forecast over the next sort of 3 weeks or so. You maintain that we have seen that bear market rally. I mean, are you making positional changes there at the moment, Mark?
No, really. I mean, it always had the hallmarks of a bear market rally for us. And I sort of wrote for the newsy the afternoon newsletter last week, around this, and essentially, they're always short and sharp, and bull market rallies tend to be a bit more of a grind higher, and they're far more sustainable. Nothing's really fundamentally changed. I mean, from Liberation Day, we still have more tariffs than what we did prior. So fundamentally, the market hasn't changed, and this optimism is really probably, really a symptom of shorts being caught out, people getting FOMO. It's very psychological. So it hasn't changed our plan. I've traded through most black swan events or bear market rallies since the early 2000s, and these are not uncommon at all. And we've been steering our clients via the historical averages, which is the best way to go about things.